Good afternoon. Good afternoon and welcome to the press conference following the quarterly meeting of the Shadow Financial Regulatory Committee. We have some changes in membership I would like to announce to you. Bob Lightan, who's been a member of this group for a number of years and served as co-chairman for a while, has changed jobs. He's now worked for Bloomberg, and Bloomberg has a regulation that he can't be a member of groups such as ours. I guess that's above Bloomberg, so Bob has resigned. We have a new member in Sheila Baer, formerly of the FDIC. Sheila is not with us today. She was with us at yesterday's meeting, and she is a co-writer of one of the statements that you'll see. We have 3 statements. Before getting to the statements, let me introduce the members of the committee who are with us today. On my right is Bob Eisenbeis. On his left is Kathy Strand. On my left is Frank Edwards, and on Frank's left, I've only known you for 30 years, 40 years probably, is Ken Scott. Sitting in the audience is Ken Dam, Peter Wallison, Charlie Calamaris, and Chester Spat. We have 3 statements. The first statement is 329, which deals with money market mutual funds, a topic that's a hot item in Washington these days. Statement number 2 is 330, which deals with LIBOR, another hot topic. And our third statement is 331, which deals with the disclosure provisions in the Dodd-Frank Act, which interfere with the disclosure provisions that the SEC uses, not too unusual. Frank Edwards will discuss the first statement on money market funds. Frank?
Is this on? Can I? All right. Good morning, or good afternoon, I guess I should say. It's a pleasure to be here with you today. I hope that everyone has a copy of this statement. It's a fairly long statement. No? We have some back there. I think it would facilitate things if you did have a statement, because I'm not going to cover everything in this statement. Otherwise, it might take too long. I'm also going to read parts of it because I want to get it right. But in essence, you know what this statement is about if you've been in Washington. It's about the fact that Chairman Mary Shapiro of the SEC some months ago proposed reforms to be imposed on money market mutual funds for the purpose of, in her view, reducing the likelihood of a destabilizing systemic run on money market mutual funds, such as occurred, if you go back to remember, in 2008, where as a consequence, the federal government, in their view, had to intervene to support money market mutual funds in order to stem the run. So that was a very provocative move that the federal government made, and naturally the Shadow Committee has done a lot of work on systemic risk, so this is a natural topic that we would be taking up and discussing. Now, this is not the first effort we've made in this area. We've actually had 3 prior statements in 2009 and 2 in 2011 and 2012, where we've, should we say, slowly pieced together our view of this as it has unfolded. And I have not included anything on the 2009 for sake of brevity, and I do quote in this statement what we said in both the 2011 and the 2012 statements, and I'll read some of that to you. But I think to set the stage, I just want to read our introductory paragraph, which is, in a sense, a summary of what Chairman Shapiro's proposals were, which, as you know, were abandoned in the last couple of weeks for lack of support among the 5 SEC commissioners. And then I'll just sort of summarize in my words, not in the statement, but so where we come out on this, and then try to tell you why the bulk of the statement really is why we come out where we do. Okay, so to start, I would say that just set the stage a few weeks ago, the chairman of the Exchange Committee, Mary Shapiro, announced that the SEC would abandon its effort to impose new regulations on money market mutual funds because 3 of the 5 SEC commissioners refused to support her proposed regulations. She had proposed 2 major reforms directed at preventing destabilizing runs, in her view. And the first would have replaced the fixed net asset value, par value accounting rule now used by money market mutual funds, with the requirement that money market mutual funds report their fund values at actual net asset value, which we call NAV, net asset values, or by using standard net NAV counting rules like all other mutual funds. So that's the first proposal she made, shift the standard accounting rule used by money market mutual funds to that very similar to used by other money market funds, which is mark-to-market, if you will, or net asset value pricing. The second reform would have imposed a regulatory determined, quote, cash reserve, in her words, on fund sponsors if their funds opted to continue to report fund values at stable $1 value. So it's kind of like an, either or type proposal. Everybody go to floating NAV, or if a fund sponsor does not want their funds to redeem with a floating NAV, they can maintain some kind of reserve, cash reserve, whatever you want to call it, liquidity reserve. Some people refer to this with different words, or capital. I prefer the word capital, cushion against possible redemption demands that they really guarantee will be at par value. Okay, so, where do we come out on this? Well, skipping ahead, after our 2009, 2011, and 2012 statement, I'm going to summarize that by reading you what we say in the third of these statements, the most recent. And we come out with the following 4 proposals. 1, apply the floating NAV model to retail as well as institutional money market mutual funds. Why that's statement like that, stated like that? Because initially we had left retail funds sort of without a strong statement, and just really suggested we do this for institutional funds. So in sense, the 2011 statement is an expansion of our prior statements to retail as well as institutional funds. 2, permit money market mutual funds to be exempt from this floating NAV model or requirement if they are sponsored by fund companies that provide an explicit contractual guarantee to investors in these funds that their money market mutual fund investments will be redeemed upon demand and at par value, the fixed $1 amount. So in other words, explicitly, we know that some fund companies already do this. Sometimes they come to their fund's aid with some, if you want to call it a bail-in or whatever, so they don't have to break the buck. But we're asking here that, if that's going to be your policy, make it explicit. Number 3, impose the capital and liquidity, capital and liquidity requirements on fund companies that sponsor so-called guaranteed money market mutual funds as well. So this is saying if you're going to provide this explicit contractual guarantee, then you have to back it up with something. Okay, so that would require some kind of capital. We don't go into detail on exactly how you would hold capital. There are many competing possibilities out there. Many of them would be okay with us. Academics have written on this rather extensively and have some proposals which impose partial capital requirement on other fund customers and some just on sponsors, some mix it up. So we're not telling you exactly how to do that. 4, mandate that all money market funds publicly disclose sufficient information to assure that all money market mutual fund investors are aware of and understand the differences between a sponsored guarantee money market mutual fund, money market mutual funds that operate under a floating NAV, and FDI insured deposits. Right, because these are three, in some sense, competing models you could have for cash management. So we just want to make sure that everybody who's in one of these funds knows which one they're in. Okay. Now, these proposals, and we can not always say this, I might add, it's somewhat unusual. These proposals are really quite similar to those advanced by Chairman Shapiro. This is usually not the tack that we take on regulation. Usually we're criticizing somebody somewhere. So this puts us in a very awkward position of actually having proposed things that the SEC actually thought of adopting. But notwithstanding this outcome, and that Chairman Shapiro's proposals enjoyed widespread support among many informed parties, the White House, the Treasury officials, the Federal Reserve, the Bank of England, the Wall Street Journal editorial page, the former Chairman Fed Volcker, former Treasury Secretary Henry Paulson, and many, many academics and some other academic groups. These did not make it, right, because of more or less a decision by 3 of the other commissioners that they could not support these proposals. So in some sense, our statement, therefore, is in response to how come these proposals got shot down. We thought they were pretty good. It wasn't only Mary Shapiro that thought these were pretty good. We thought they were pretty good, too. So we took this kind of personally, I guess you'd say. That would be like shooting down our proposals. So we'd have to revisit this issue again. So the main arguments, what are the main arguments? We thought the main arguments against adopting these proposals is that they would impose higher cost on fund sponsors and make money market mutual funds less attractive to investors, resulting, probably, in the shrinkage of the money mutual fund industry. And particular, a capital requirement would impose increased cost to fund sponsors. That might have to be fed through to investors in the form of lower yields. And an NAV, a floating NAV, would impose risks on the investors because they could take a loss because of asset values. So either of these things could make this a less attractive product, and opponents to this bill certainly believe that, and that's a major source of the objection. So anyway, make a long story short, the Shadow Financial Committee does not really find these arguments compelling, and for a number of reasons. And then we go on to say, in effect, what's going on here, in our view, is that there's an implicit government subsidy of money market mutual funds, because after all, when things got going, when the tough got going, the Federal Reserve had to come, not the federal government had to come in there and, in a sense, guarantee funds, and that's just like guaranteeing deposits in some sense, right? The par value of deposits. So that's an implicit guarantee that we're talking about, and to the extent that that exists when the free market wouldn't have it exist, because if you just if you really marked assets to market, which is what we don't expect markets to do generally, this is an implicit subsidy to the mutual fund industry, and we have a hard time trying to figure out why that should be socially optimal to do that. So from that, we derive a number of statements and a number of arguments in this statement about why we don't think this is a good idea and why this subsidy shouldn't be a taxpayer subsidy. It should be shifted to either fund sponsors or mutual fund investors, one or the other. And to make a long story short, we have a number of things to say about how to do that, but essentially we're arguing that by adopting a floating rate NAV and a capital or a capital requirement such as proposed by Commissioner Shapiro, that would in sense shift a lot of this subsidy away from taxpayers and either put it onto fund sponsors or the investors themselves, and that's where it belongs. So that's where we stand on this, and I just want to make some, so in case it comes up, finally, in the end, if we don't adopt these, since we haven't adopted these proposals, what's next? Well, the press has mentioned some other alternative regulatory measures, such as under Dodd-Frank, designating all large money market mutual funds as a systemically important financial institution, or designating the entire money market mutual funds as a systemically important industry. We don't really want to go there if we can help it, right? So we think our proposals are a very vastly superior way to go than that. And, you know, without elaborating on that, I'll just say thank you very much, and I hope you read. I hope you have a lot of comments. Thank you.
Thank you, Frank. We'll follow the usual procedure, summarizing all our statements first and then opening the floor for questions. Our second statement is on LIBOR, and Bob Eisenbeis will present it.
Thank you, George. I'm going to revert to our more traditional role of criticizing regulators. So we can, and what we do is take another look at the recent settlement and implications behind the Barclays settlement of $452 million roughly for alleged manipulation of the LIBOR rate submissions to the British Banking Authority. This is a problem that's been festering for some time. It first arose most recently in 2008 with a Wall Street Journal article beginning to question the efficacy of the submissions on LIBOR, and has been essentially dawdling along in the regulatory agencies for some while. This is an issue because of the importance of the rate and the broad spread of contracts that are tied to the LIBOR, that this kind of a problem should be lingering is one that has caused us some concern. Part of the issue is the fact that the LIBOR rate is in fact not a transaction rate, but it's a guesstimate about what an institution could borrow. And I'll cite some specific quotes in just a minute as to what the rate is actually. Now, questions about the manipulation of the LIBOR rate are actually been of two forms. The first, which actually goes back well into the 1990s, in the latter part of 1990, relates to some alleged manipulation of the rates by traders in Barclays and several other large institutions who attempted to influence, and these were derivative traders, who attempted to influence the submissions of the LIBOR rate to essentially protect positions that they had in their derivatives portfolio. And this is a case where sometimes because of the exposures they had, they may have wanted a higher rate submitted, and other times they may have wanted a lower rate submitted. This area is one that's now being subject to substantial litigation, and there's a lot of cases that are hinging on the evidence that's going to be discovered. The second involves actually the more recent concerns that have been the subject of testimony before the British Parliament, and that has to do with the alleged submissions during the financial crisis by Barclays and some other institutions as well, who essentially were alleged to have submitted lower rates than they were actually able to borrow at in some cases, so as not to signal to the market that they were of weaker financial condition at a time of crisis than in fact they might have been. So just as one little bit of background to elaborate on the point I made earlier, the LIBOR rates are submitted to the British Bankers Association, who actually has delegated the construction of the indices to Thomson Reuters. And the submission really is done in answer to the following question, which you can find on the BBA's website. At what rate could you borrow funds were you to do so by asking for and accepting interbank offers in a reasonable market size just prior to 11 o'clock, and that's London time. The London time, 11 o'clock, is because that's the time when most of the markets were open around the world, and that was a common time. Interestingly enough, if you go to the British Bankers Association website, even today, despite the controversy, you'll find a different definition as well. You can find two conflicting definitions. One of them says it's an actual transaction rate, which it is not. And so why this is, I think, symptomatic of the lack of attention that these institutions and that the BBA has paid to this particular problem. Now, for such a rate submission to be meaningful, obviously it has to be truthful, it has to be credible, and there has to be an honest estimate. But as we've seen from behavior and evidence, it suggests that this way of constructing the index is based upon conflicting incentives on the part of the institution to actually provide a meaningful number. And that's the reason that we think that it's time to actually step up and reform the measures. Now, both the regulatory agencies, both in the U.S. and particularly in the U.K. and the BBA, bear some heavy responsibility here because to actually have dealt with this issue in a more prompt manner. This is clearly a case where they were at fault because there's been ample evidence for a long period of time that this has been a problem. And yet, and because of the importance of the index, the wide range of contracts that are indexed to it, it's essentially important that that index be constructed in a way that's credible, that's meaningful, and probably based, we would argue, based upon underlying transactions rather than guesstimates about what you could do. The committee believes that LIBOR should be redesigned and it should be redone promptly. It's time to get off the stick and move on this particular issue. That it's been languishing since 2008 is pretty much inexcusable at this point in time. Now, it's been suggested that government regulatory agencies should step in and assume this responsibility of constructing the index. And indeed, Chairman Ben Bernanke has actually testified that there are several alternatives. And there's a lot of ways to construct the index, and people have been anguishing over how to go about it. We don't think it's that difficult. Essentially, we feel that the index should be a transaction-based index, and there should be some regulatory oversight of the index by the responsible regulatory agencies. There should be a protocol put in place, which is one of the problems that people have cited. The fact that certain periods of time, particularly during a crisis, the rates aren't actually available. Certain transactions didn't even take place. There needs to be some protocols put in place as to how to deal with that situation. We think that's a solvable problem. And because all of the institutions that do the submissions are subject to regulatory authority, we think that the supervisors should have at least some responsibility to oversee and enforce the submissions, and it should be done in such a way that the regulatory agencies work with the institutions and work with the responsible market regulators to ensure that the rates are done in a proper way and that the submissions are truthful, and if not, there should be appropriate penalties brought in play. I think one of the things that we would argue is it's probably not the regulatory agency's responsibility to actually define the index. The institutions are much better positioned to design an index that meets the needs for the contracts to which the index is tied. And so we would argue that the industry should play the lead role in developing and redesigning the index, but now is the time to get on with it. That'll stop.
Thank you, Bob. Our final statement is on corporate disclosure provisions in the Dodd-Frank Act, and Kathy Schran presented.
Thank you. I'm going to start with favorable comments about the SEC also in the tradition of Frank, which is that the SEC has had authority to regulate disclosures in U.S. securities markets since the 33 and 34 Act. And you can look at specific provisions and rules that they've made and argue with them, but the process that they have is deemed as successful. And companies, capital issuers from foreign jurisdictions come here to bond themselves to our set of rules and subject themselves to our rules, knowing that they lower the cost of raising capital. The Dodd-Frank Act of 2010 intrudes on this authority that the SEC has and this well-established process to formulate disclosures in the regulatory filings. we say in our statement here that they intruded via several provisions within the Dodd-Frank Act. The SEC, in a summary of their progress in implementing these provisions, actually delineates 90 separate provisions within the Dodd-Frank Act that they need to address via additional rulemaking. And we have two problems that we note in our statement that arise as a result of this congressional mandate about disclosures. The first is that some of the mandated disclosures have no clear relationship to financial reform or consumer protection. And the example that we provide is from Title 15. Section 1502 requires disclosures about conflict minerals. Section 1503 requires disclosures about coal mine safety and health violations. And 1504 requires disclosures about payments to governments by firms in the resource extraction industry. So we see these disclosure requirements mandated by the Dodd-Frank provisions as a mechanism by which Congress can promote social causes rather than promoting investor protection necessarily. The second problem that we have with these mandated disclosure provisions in the Dodd-Frank Act is that they override the process that the SEC engages in of due diligence in evaluating required disclosures. These disclosure provisions were mandated without consideration for whether they would withstand a careful cost-benefit analysis. And in fact, there was a recent court ruling in the District of Columbia Circuit Court of Appeals related to Rule 14A11, the shareholder proxy access for director nominations. And the case is the Business Roundtable versus the SEC. And the rule that was established, Rule 14A11, was successfully challenged on the grounds that it did not withstand a careful cost-benefit analysis. It was not supported by that, even though the SEC was basically required to mandate such a disclosure. So in summary, we view these mandates by Congress for additional disclosure as a way to circumvent this established process that the SEC has. The consequence of that is that corporations are subject to disclosure requirements that are costly for them. There's no discernible benefit for investors in some cases, and in other cases, the benefit at least doesn't exceed the costs.
Thank you, Kathy. We now have time for questions from the audience, and I mean questions and not speeches. If you direct your question towards any of the committee members either sitting here or sitting at the front table, and if you give us your name and affiliation. Yes, sir. There's a microphone. Oh, you're a mic holder. The audience. No questions? There's a question. I didn't know that we were as non-controversial as this.
Since there are no questions, I'll tell you what I'm perplexed about. When you say money market funds, mutual funds, do you mean also the funds that are in the broker that a broker keeps when you keep money on the side at at Schwab or TD Ameritrade? It goes into their money market fund. And the second question is, why would the federal government guarantee savings and loans and credit unions and not guarantee those money market funds? They seem to have more regulation through the SEC on mutual fund people than they do to credit unions and banks, even though they say the opposite.
Before Frank answers it, can you give us your name and affiliation, please?
My name is Mike Zone, and I'm a interested citizen.
Well, thank you for those questions. I'll take the second one first. As much as I understood it, as I understood the question, you're asking why wouldn't they guarantee money market future funds if they're also guaranteeing bank deposits, right? I think that's essentially. Well, I think that if you go back in history, the reason we guaranteed bank deposits was the fear of run-on banks, all right? And similarly, once you do guarantee those deposits, that led to a lot of regulation. For one, deposit insurance, right, which imposed a lot of regulation on banks, and two, capital requirements for banks generally, as well as all kinds of asset restrictions, liquidity restrictions, capital requirements. So money market mutual funds, as you know, are not regulated anything like a bank. And the reason for that is government insurance of banks. So it's understandable to me why you wouldn't want to guarantee money market mutual funds, because it would make money market mutual funds essentially into banks, which would call forth lots of regulation. So the first point, if I recall, what was the first point now? Oh, yeah. Well, I think, do you mean ETFs? In exchange traded?
Brokers, captives, brokers, money market funds. The answer is yes. Right.
What's the question?
If you're margin.
Yeah, well, yeah, okay. What we certainly looked at here, I don't understand. We looked at all money market mutual funds. Yeah, we looked at all money market mutual funds. So I'm not quite sure. Maybe I misunderstand the question.
When you have money in a brokerage,
Yeah.
and you sell stock, let's say you sell your
Oh.
stock that's swept on a daily basis into a mutual fund,
Right.
money market fund that the brokerage runs.
Yes, well, we are talking about those, and that is a money market mutual fund that it's swept into, right? Doesn't matter who sponsors these, in our view, it's what they do. When they're money market mutual funds, then that's what we're talking about. And we're talking about, there's nothing wrong with that, as long as they want to mark your assets at market value rather than basically promise you to repay them at par value, no matter what happens to the assets in that fund. Okay, so yeah, they're all lumped together.
So since you get the same interest from both of those, wouldn't it be better to take your money away from the to not ever deal with a money market mutual fund? Deal with to sweep that money yourself into a bank at the
You
end
could
of
do
the
it,
time.
but the reason the money market mutual funds have been so successful is they usually pay somewhat of a higher yield than bank deposits do, right? And so that's why they're made so attractive. The question is, how can they manage to pay such a more attractive rate than banks? And we argue one of the reasons for that is they implicitly getting a government subsidized in terms of their ability to meet par value redemptions.
If you go back in history on this, money market funds were formed basically at a time when goes back 1972, I guess, when the Fed was putting a ceiling on the rates that banks could pay on deposits. In other words, you had a government-run cartel, a oligopsony, a buyer's cartel for deposits that was enforced by the government at a low rate. And there was market pressure to try to find ways to get something closer to a market rate than the government-mandated rate that was favorable to the banks, not the savers. So there were various devices that were found. If you think back to it, there was the Eurodollar market and so on. Another one that was available to retail savers, customers, was treasury bills. And treasury bills were auctioned and paid a market rate, and it was higher than the banks were paying under Reg Q. So funds were starting to flow away from the banks and into treasury bills directly. And the response to that was, oh, no, you don't. We will raise the minimum purchase amount on treasury bills from $1,000 to $10,000 and try to force small savers to stay with the bank rate. And that, in turn, led to the invention of money market funds, which could pool small amounts and buy treasury bills, even with a $10,000 minimum. So money funds were originally a source of competition for banks when banks were benefiting from a artificially low rate set by the government.
Jillian?
Gillian Garcia, World Bank. It seems to me that the committee and Mary Shapiro's arguments are so obviously correct. I can't understand why 3 members of the SEC would vote against them. So I ask, did they use the reasons that you quoted, that it would harm the industry? And if they use those reasons, then my question is, what are they doing on the committee, on the SEC? I mean, what is their mandate? Who are they supposed to protect? Is it the public, the taxpayer, or are they there as to be shrills for their industry?
Deep question. I don't know whether we're qualified to answer that political question. But yes, at least one commissioner who I've read his dissent on, the things that he said in speeches, more or less does use the arguments I've said. But it's fair to say that I think some people think that they're valid arguments.
Over here.
Mark Breifogel. I'm with Onlager Research. We're a small hedge fund, really. Political question, not really a rhetorical question. Very difficult for anyone up there to answer. I guess I'm sending this to Bob. A man named Andrew Fastow has been rotting in prison these last 8 years. His company would take large derivative positions against illiquid markets and then move the underlying at enormous profit. And of course, this was scandalous, and within 2 years he was in jail. The LIBOR market is 1,000 times the size of the electricity market. What they're doing is huge implications, and no one seems to be angry. No one seems to be taking any action. You might say that Enron was just a little fly and it was easy to swat them, whereas banking is international and huge. But again, tough question. Do you know why there's no criminal investigation, A, and B, does it really not make the case for breaking up the too big to fail banks? Because I think they obviously have so much political influence. Thank you.
Well, first of all, we do know that there are a lot of investigations that are presently ongoing. There's at least 3 within the United States, and there are investigations going on in a total of around 7, 8 different countries at this point in time. So it may be premature to sort of say that there are no criminal investigations. I think the impatience that we should see is more related to the delay and how long this issue has been festering. Excuse me. I did find it interesting, having viewed the hearings when Bob Diamond testified before the UK Parliament, that he didn't seem to really get it when it came to these submissions, that they really didn't take them all that seriously, didn't think that it really involved risk as part of the institution as a whole. And of course, what surfaced was the fact that there was reputation risk of a huge amount, and obviously it cost him his job. I think all of these are valid questions as to why the agencies and why the regulatory authorities didn't step in and act more promptly, particularly if you read the transcripts of conversations and everything else. It was pretty well known that there were a lot of questions about these submissions. I think clearly there are just a raft of lawsuits at this point in time, so it's going to be a lot of cost, I think, ultimately when these issues get resolved. Whether there'll be criminal submissions, obviously, if it's fraud at some point, this will come out. And of course, a lot of it involves activities in the UK. And to be honest with you, I don't know what their laws are. I would be surprised if it's substantially different when it comes to fraud and fraudulent submissions of information. But presumably, this story is not yet near its end, I think, is the answer. Whether it calls for breakup of big banks, I mean, first of all, there's I think presently 20 submitters right now. Only 3 of them are U.S. banks. And it's not clear whether and to what extent the U.S. banks were or were not involved in some of these decisions at this point in time. So I think, as I say, this is a story that's yet to be totally unfolded.
The SFO, the Serious Fraud Office in the UK, has taken the LIBOR inquiries, taken jurisdiction over them. That's a criminal proceeding. The Department of Justice Criminal Division in the United States is engaged in its own inquiries. So, as Bob said, we'll see.
Yes.
Bob Feinberg, and I've been working on the financial crisis for several decades. So, on the point that Bob made about these hearings at Treasury Committee, 2 insights I think that came from that are, I think Diamond was intimating at one point that he thought that, or at least some of the members suggested, that maybe he was getting signals from the regulators that his submissions were too low because they were giving the impression that Barclay was weak, and this could lead to some kind of a bailout. And then he had an explanation that he had raised some money abroad. That's one thing. And another is that apparently the reason he lost his job was that the regulators said, you've become a pain in the anatomy because you're always pushing something. You're always trying to push the regulations, things that we take for granted over here. And they finally said, we don't have confidence in you.
Well, pushing regulations is a good U.S. tradition. Hugh McCall did, and Walter Wriston did. So this goes way back in history. It's always a case of trying to find where the boundaries are. That's what I tried to suggest in the material that I discussed, is that there are actually 2 dimensions to this LIBOR issue. The one that's gotten, and that was the focus of the hearings, was this allegation that, in fact, the regulators are telling Barclays to submit lower rates because of the financial crisis. And Paul Tucker, I guess it's Paul Tucker, was the one presumably who had those conversations, and it's still not clear who told what to whom and what was interpreted, and whether there was winks and nods involved. It's questionable. Yes, but by the same token, the other issue of the derivatives trading situation, there's at least 300 and some different requests that have been documented where traders made requests of the submitters to do something in the interests of their derivatives positions. And that's another whole set of issues and part of this dimension. And questions about that go back to the late 1990s.
Some of these were done in the open air.
Yes.
If you're interested in sanctions, Paul Tucker's ambiguity has probably deprived him of his opportunity to succeed Mervyn King as governor of the Bank of England. There are consequences.
Yeah. We've got Ed over here.
Hi, thank you. I'm Ed Keene. I'm with a firm called the Observatory Group. Question for Mr. Edwards, and then I wanted to ask a second question to everyone on both of these relate to mutual funds. So where do you see this process going in terms of mutual fund regulation, given what's happened with the SEC? Is it possible other agencies could step in? And then a second question related to mutual funds, although it's really a different subject. I'm sure as members of the committee know, there has been periodic discussion that the Federal Reserve, as part of its monetary policy, should lower the interest rate it charges on reserves. And then concerns have been expressed in some quarters that that could have disruptions to the mutual money market mutual fund industry. I'd like to hear comments from anyone about whether, if that change were actually made, to what extent it would affect the money market funds.
Well, I'll address the first one and leave the last one to somebody else. Well, who has a crystal ball? I would put it this way, that unfortunately I do not see any possibility at the moment of the SEC Commission movement on this. Will anything else occur then? There is a possibility, as I say in the last paragraph, that under Dodd-Frank, the Financial Stability Council can move to do something. What that is remains somewhat doubtful and cumbersome, but basically, as I understand it, they could possibly move to declare some large money market mutual funds systemically important institutions and bring them under the entire regulatory structure. Even they could declare the entire industry that way if they want. But I think there are some provisions about getting that done that make it very awkward and as I understand it, necessitate a cooperation among many different entities and our agreement. So whether that will happen, and besides, I don't know what the political ramifications of that are, but they're pretty consequential too. So I think that I don't see that probably happening. Who knows? So where does that leave us? Unfortunately, I think it leaves us where nothing will be done. Now, possibly maybe a new election would change membership of the committee, and that could have an effect. So I'm a little bit dismayed by the situation, but let's see.
Meanwhile, the the mutual fund industry is in a state of steadily shrinking, and it is a result of the policies of Mr. Bernanke, which means that you can't pay a significant return on money market funds. And so the industry is slowly disappearing, and we have been promised that the Fed's policies will remain the same for the next 2 or 3 years. So whatever the problem caused by money market funds is, it is clearly diminishing over time.
I guess I'm not quite sure what the connection people are talking about in terms of interest on reserves. Obviously, the main assets that the money market funds would be investing in are commercial paper and other short-term interest-bearing deposits and the like. If interest payment on reserves were lowered to some number close to zero, then the idea would be that this would be forcing banks to make loans and seek other sorts of assets. It's not obvious to me how that would have, what the logic is in connection for interest on reserves and the interest of the money funds, except to the extent that they may be paying lower interest somehow on deposits, but you can't get much lower than where they already are. So I'm not sure whether this is a meaningful argument or not.
Well, if there are no other questions, I guess we weren't controversial enough. We'll try to be more controversial when we meet again in December. We'll see you at that time. Thank you for coming.